You're about to join Jerry Parker, Moritz Seibert, and Niels Kaastrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker, Moritz Seibert, and I, Niels Kaastrup-Larsen, are excited to be back with you on this week's edition of the Systematic Investor series, where we are going to discuss the last week's events in the world of rule-based investing and take some of your questions. So good morning and good day to you, Jerry and Moritz.
Hello, Niels.
Morning. So another interesting, volatile week. I think it's fair to say. Certainly seems like many of the different sectors are starting to have a little bit more volatility in the day-to-day trading that we've seen for a while. Clearly, there's a big story at the moment, of course, with energy. I'm sure we'll get into that. But of course also fixed income didn't disappoint on the not volatility side, but certainly there was a few moves there that impacted performance during the week. So why don't we just jump into it straight away, and maybe I'll come to you, Moritz, first. Just sort of your overall thoughts about the week. Anything that you noticed that we can stick our teeth into, so to speak?
Just like you said, more volatility. The week for me has been relatively flat, just very slightly down. Down though for the month, because the first week of November was, about -3 or a bit more even than that.
Yeah.
But in this past week, we had a long position in crude, but that long position was relatively small. It got reduced toward the end of October. So we had some losses there, but they weren't that large. Net gas, once again, offset parts of that. And then as far as the bonds are concerned, bonds were rising. We had long positions in the Bund. That was good, but short positions in most of the US bonds, and that hurt. So as a result of that, flat type of week.
Yeah. Well, I think that flat week was pretty good. We certainly got hit much harder than that on our side, but mainly from the U.S. fixed income markets. Like you mentioned, whatever we lost in the sort of the oil complex, we made back in natural gas. Metals didn't do too well for us either, but certainly the dominant performance driver for the week was U.S. fixed income. So we're certainly down for the month, and then we also managed to give back what we had made up the previous week and a little bit extra than that. So yeah, I know, Jerry, you don't necessarily look at performance each day, but maybe you did notice a few interesting things in the markets that caught your attention, so to speak. Whether it's the indices or the single stocks, we're always interested to hear what's happened in the Chesapeake portfolio.
Well, it was all dominated by energy, of course. Very disappointing. In our opinion, the conclusion of the uptrend in the crude and heating oil, kind of a relentless sell-off, and the long-term strategy that is supposed to keep you in the trends and avoid the choppiness, that has a tendency to give back more profit. So kind of a very disappointing year. It seems to me that lots of these sell-offs of the long trades, they look about the same, just kind of relentless down almost every day. Fun to be in natural gas. It's over the years, 25, 30 years, it's had similar chart patterns where it skyrockets and crashes after skyrocketing. So we'll see what happens. It's fun to hang on to this trade and see maybe a trade that might be dominated by a lot of trend followers getting in and pushing it up. I did see that someone sent me the performance of a ETF that is short natural gas. So that had a bad performance one day.
And the widow spread
like
is
the
back.
XIV.
Did you hear about that? The widow spread is back. So, the front end of the curve rallied, and, we're, at least I'm I'm involved in the front end, but the March-April spread 2019, that really went up. Not sure if you saw that, but that's what's called the widow spread, because it's essentially a position on storage at the end of the US winter.
All right. I didn't get that. That was interesting. Yeah. No, I mean, you're right. I mean, it does seem pretty ferocious what's happening once we get these, market moves at the moment. And I was listening to various podcasts and watching some interviews, and there seems to be a little bit, even among people who've been around for a very long time, probably even longer than the three of us, where there is in their opinion, there is this tendency, a lot of these crashes that people fear, doesn't really show up as they would normally do, these sort of medium to long-term bear markets. A lot of them are now starting to show up as 2 or 3 weeks types, as we've seen in energy, really, sold hard down for 2 or 3 weeks. I think crude is down now 28% from its high to the recent low. I mean, in a matter of weeks. I mean, that's pretty significant. So I don't know if some of the things that you've noticed as well, when you look at the markets themselves, whether things have changed a little bit in that sense.
It's hard to say. I mean, it feels, quote unquote, feels, and it's never good to go with your feelings probably, but it feels like it's too many trend followers, too many people, and it feeds on itself. I don't know.
Yeah, I mean, maybe, although I know you mentioned trend followers, Jerry, but I don't know whether I really think it is trend followers per se driving these, big moves. I'm not so sure. If I look at some of the things we've done, and of course we do things differently in that perspective compared to what you do. I mean, we haven't been adding to our net cash positions for sure in the last week or so. On the contrary, probably taking some risk off the table because of this explosion in volatility. So that I don't know. I feel it's more short term people in that sense, maybe more algo driven than the traditional trend follower. But I could be wrong, of course.
Yeah, let's see what comes next.
Yeah, absolutely. Any major position changes that we could share with people? I have not noticed any one in particular on our side, I would say. So I would imagine you've probably not had any big changes either on your side. Any of the single stocks that were interesting this week, by the way, Jerry, that you noticed?
I didn't notice anything unusual, or it's a pretty quiet week for us on the single stocks. So yeah, I think the bond market was sort of interesting. I've been on record on this podcast talking about all these bonds that are sort of correlated, highly correlated. Yeah. I don't like having big bond positions. It's almost one market, and yet there are some uptrends and some downtrends, and I think they're all intact. And it's very interesting how different they look on the chart these days.
Yeah, that's for sure. Any interesting news from the sort of the world of systematic trading or hedge fund world, as we can be included? Anything that you've noticed on that front before we jump to your top tweets for the week? Any articles that caught your eye?
None on my side.
No.
Nope. Fair enough. We can't have new things happening every week. So why don't we jump to some of the tweets? Let's see what people reacted to from your point of view, Jerry.
Yeah, I had a couple that stood out this week. I think one that got a lot of attention was I did a retweet of something Moritz tweeted that people liked, and he says trend following is rough, but it's better to be roughly right than precisely wrong. Keeps you in the game. People love that. They love how it sums up what we do, and it's okay for it to be rough, but we're thankful that following prices keeps us safe as long as we trade small.
Yeah.
I think trade small, follow your system, and hopefully your system's based on price. Those are two hugely important things that and I had a friend call me up yesterday closing his fund, and he said, I thought there was a niche for aggressive trading for large returns. I've been there. I mean, there is a niche, but being able to pull it off is a whole different thing. Being able to sit there and your clients sit there when you're losing lots of money. So that's difficult. And then it forces you sometime to not follow the system. And another trader in Europe I saw down 25% last month. Great trend follower, love this guy, but I don't know. I think that's really an issue. Let's get back to making 8% and having a lot less than a 50% drawdown. Don't try to be any better than that. I think when you try to get too good or make too much, you can get into lots of trouble.
Yeah, I mean, I think it's interesting that you bring that up, Jerry, because I remember, probably around 15, 20 years ago, there was a lot of funds being launched where managers, including some of the managers that I worked with, where you would do like a 2XL version or a 3XL version of your product. And of course, it was very hairy. And we know that some managers, and certainly some managers that I've interviewed on Top Traders, that were launching some really highly leveraged versions of their own product. And that seems to have been completely reversed. I mean, certainly on our side, what we've done is actually launch, some years ago now, but like a half leverage version, as you rightly say, trying to bring it back to a level of volatility where there is a much higher probability of people staying with the strategy for the long run, and obviously trying to make improvements that also allows people to stay with the strategy. So it really seems that that has changed a long time. And I think it also has to do with the fact that it takes a long time for people to kind of change their opinion of certain things. And clearly we've now had a long period of time with relatively low volatility in the equity markets. And that's maybe what we're reflecting now on our side by having lower volatility products. But then maybe, who knows, when volatility comes back and everybody gets used to, 15 to 20% volatility again, then we're all going to go back and launch higher vol products. Maybe. What other great tweets did you have this week, Jerry?
Let's see here. This one sort of stood out, and I don't know really why. So we can.
Okay.
I have my own guesses, but this was a quote. Every world-class investor is questioning right now how they can improve. So in a machine-driven age where everything is driven by speed, perhaps the edge is judgment, time, and perspective. Unquote. Then I put and trend. So I doubt that the part that made it popular. But I do think that we kind of want to hope that that's true, that our judgment and perspective and these human qualities we have we want that to have a positive impact. And maybe we think that, well, we don't have AI, all we're doing is trend, or our analysis with spreadsheets or whatever all of us are doing. So hopefully these other things will mean something and kick in, and I will be able to compete with complex machine learning with all of these different tools. Maybe I'm not sure, that might be wishful thinking, but I think we hope that's the case.
Yeah. What do you think, Moritz, when you hear something like that?
Yeah, I agree with that. And it's just as you guys spoke, looking at the Twitter feed of things that I thought were interesting also in the past week. And I think I shared that paper from Jim from 1987. Not sure if you remember. Where I thought, well, that's just great. I mean, that's like 30 years in the past, more than 30 years in the past, and And so much wisdom in that paper about systematic and quantitative trading and the advantages of that style compared to discretionary decision making. So I really, really like that.
Yeah, and you say Jim, but maybe we need to give people a little bit more clue to who Jim is.
Jim O'Shaughnessy.
Yeah.
Not sure if I'm pronouncing that right, but that's him. I think he's running an asset management firm in the States, so people can surely find him on Google. That's not a problem. But really, really interesting paper, and not sure why.
What were some of the key takeaways? I know you came across this paper a long time ago, as far as I recall. What are some of your key takeaways? And is this something that we kind of tend to look at when things get a little bit rough, and we need a reminder about some of the benefits of being systematic?
Yeah, it's all about the biases that your mind is just prone to trick yourself, right? Every time there is a bit of volatility in the markets, you think you maybe know something better than other people, and at the end of the day, you end up outsmarting yourself. So having that compass, that just that guide, which are the rules, and following them relentlessly, that is such a great advantage. And doing that over and over and over again. I think, this is the essence of that paper, but it's like 30 years old. And I was kind of like, wow, very interesting that it hasn't crossed my desk yet, because, we're all looking out for those type of things. But this one was a gem.
Yeah, it reminds me of a conversation Jerry and I had with Richard Dennis when we did our turtle conversation a while back, Jerry. I don't know if you remember, but I think Rich kind of ended the conversation by saying something like, well, maybe the trend is your friend, but the rules are definitely your guardian angel. Yeah.
Yes, that's something I've believed in, and that's been my history. Whenever I haven't followed the rules, and sometimes due to high leverage and large losses, it's never worked out. So I love following the rules.
Yeah.
And speaking about leverage, I'm looking at one of the tweets that you sent, Jerry, a couple of days back. It says, how can a systematic strategy with FX, fixed income, stocks and commodities, long short, not provide superior risk-adjusted returns? ? And then you answered, well, no single stocks, not enough single stocks, high fees, high leverage, robustless vol targeting, and adding non-long-term trend following. I agree with all of that. And I think one of the things that we haven't touched on in episodes prior is the high leverage, right? Because you can have a good system, but if you gear it up too much, if you start running that at 50 vol, right, or 60 vol, then you're very likely to not make it to the finish line, because you'll get into such a large drawdown and probably blow up.
I think that's a great point, Moritz. Definitely.
I was definitely one of those.
There are some funds out there that deliberately deploy high leverage, and you could say, well, that's an efficient and good use of my capital, because if my margin to equity ratio is something like 15 to 20%, then 80% of that money sits in T-bills. So how about I increase my margin a bit and trade more aggressively? But the problem is, you get one hit, or you like 2-3 successive bad months, and you're kind of like out of the game. That can't be the aim. That can't be the goal.
That's right. That's an early lesson that I was taught. Whatever it takes, preserve capital and stay in the game. And I was one of those guilty of a 2X and a 3X. And my theory at the time was, well, as long as you have the 1X, if you're a high vol trader, the problem is that you lose confidence, and absolute returns kind of matter. And the client really doesn't know if you're losing money because of the volatility, or if you're not trading well and you've lost it or whatever. But if you still have this 1X and it's tied to the 2 and the 3, then you can say, oh, I'm down 20, but really only down 10. Look at the 1X program. But that soon falls apart as well, because absolute return, sort of matters, and one must treat those two investments differently from a risk point of view after a major loss. So it's nothing worse than trading large. It leads to all sorts of, bad ideas and reactions. We're going to react. It's not like the stock market where they say, okay, we're down 50 or the NASDAQ's down 90, just hold, hold onto what you have. This is the secret to investing. Buy and hold, don't touch it. If you touch it, you're weak. We don't believe that, and we take action.
So with that in mind, and just talking about sort of leverage and volatility and things like that, I mean, given the changes we've seen over the years, and also where the CTA industry and the trend following industry came from in terms of return expectations, volatility, expectations, so on and so forth. In your opinion, what is a good range for a trend following system today in terms of, return expectations and volatility? What would you say is a number where people should, certainly be very comfortable investing in something like that, given what we just talked about?
I mean, in terms of vol, you see CTAs starting at like 5 vol, which is not where I'd like to be, but like very, very low.
Yeah.
And you see them go up to like 30 vol. I mean, there are some very successful 30 vol funds out there. And I think they're great. It's just, I think if you go higher than 30, if you go 40, 50 vol, then at that point you're in an area where there's just a lot of risk of just suffering from one bad event that takes you out of the game, and then your chips are gone and you can no longer play. So that would be too risky for me. But anything between 15 and 25, kind of like that checks the box. That's where I'm comfortable with things.
Yeah. What about you, Jerry?
Well, once again, I think 10 to 15. Our research, if it's pure trend following, it has a tendency to have a drawdown about twice as large as the return. So the proverbial 8% return, 16% drawdown, or something like, probably going to be a little bit bigger. That's 5%. Shoot for 5% above risk free. And this is in hindsight. I'm pessimistic. We've lived through tough periods, so now we're like, we should really trade small. But leave it up to the client. For many years, we took managed accounts and they were partially funded. And so really the client can make that decision now. And it's not up to, it's really we don't really know, we have to choose from a business point of view. Should we be low? Should we be medium? Should we be high? Should we offer all kinds of options? It's better if the client kind of can, that's one of the benefits of CTA managed accounts. The client can effectively sometimes gear you up or gear you down. So probably good consultation with clients, because the reason we want to stay in the game is because it is a business and we do want to keep clients and keep our company going. So getting on the same page with the client, that's a good idea.
Absolutely.
Yes.
Anything else that we can dive into before we take some questions? Any other tweets, comments, reactions, articles? I think both you and I, Jerry, listened to a podcast, an interview actually with Cliff Asness. So not one of their own podcasts, but again, an interesting view from his side. Always good fun and interesting. And he certainly touched upon this thing about that also in their business. It seems like every 10 years or so they have a really rough time, and this is one of them. But other than that, I don't think there was anything sort of new in that conversation, but it's always good to hear it from another angle, I guess.
Yeah, that was fun. He's very interesting. I had one other tweet that didn't get a lot of interest, but I liked it. It was one of my favorites.
Good
topic. It's one of my topics I like to hammer on.
Yeah.
And it was, the title of this article I read was Evolution and Adaptation. Trend followers are constantly changing. And my point was, some are constantly changing, or they say they're changing. The key is to know what to change and what to never change. And change comes with its own cost. And to some degree, I think change can act like inconsistency. If you're changing a lot, you're not following the system, and because you just changed it. So now you're going to start following this new system or these new parameters. And the market gods, they don't really know that you slept in, or you decided to get out early, or decided not to do a trade, or you just changed the parameters. It's basically, I think this is kind of the same thing from the math gods. You need to be consistent, and making change is good. And the one thing I would never do would be to change my systems based upon short-term performance. The most recent data, overweight the most recent data. And I think that's tempting because, quote unquote, the markets have changed. They always change when we lose money. We're always worried about that. So I think that change definitely has cost. I remember one year we had a problem in 2012. We underperformed, and we went in and we decided to make some changes. And they were reasonable philosophical changes, not data mining, but we sort of identified that we were getting in trades too quickly, putting on the whole trade at one time, basically. And we said, okay, let's spread it out a little bit. Common sense makes diversify our entries, make sure that they're diversified. We thought we had a systematic approach, but it failed. And then I remember in 2013 going in there to the research guys and saying, okay, we're ready to install these new ideas. And they were like, yeah, we're ready, but the old systems are continuing to outperform these new ones. So I was like, really? They said, yeah. So then we said, okay, let's wait till next month. And then next month, the same thing. So we said, okay, let's wait till the next month. So next month, the same thing. So when you zig and zag, the markets you may make an improvement, but the old stuff might work just as well or better.
Yeah. I mean, I think that's a great point, and I think it's a conversation that often comes up with investors when things are tough, because inevitably some people will think that things the markets have changed and you need to change with it, so to speak. I mean, like you, Jerry, we don't make many changes. I can think of 3 major ones in the past 12 years on our side, and so it's not a lot, and you're right, one should never make changes because of performance. It should be because you found something that you truly believe will be a better version of what you've got, and so on and so forth. But I think that's again the emotional side that drives this conversation as to, oh well, you're losing money. Do you need to change things in your system? And very often the answer is no. And I think that's another thing that investors get when they invest with experienced managers, and that is the discipline not to make too many changes, because every time you do, there's a risk you get it wrong, and that's just the way it is.
I agree with that. I think this is really where experience comes into play, and where it's very, very valuable that you've seen those kind of environments before, like last October, right? Red October. And you don't want to, like Jerry said, you don't want to just jump the gun and say that has been bad short-term performance, and as a result of that, I'm going to change my system and maybe reduce equities because they produced most of the losses, right? Whereas if you're new to that game, newer to that style of trading, yeah, you may be tempted to do that, and look at things to change your system, make it more reactive, maybe faster, and that doesn't work. I think that is just not a good way of going about it.
Yeah. So I liked your tweet as well, Jerry, even if others got more reaction during the week. Should we take some questions? Are you up for that?
Yes.
Yes.
Good. First question is all the way from the lovely place of Ireland, and it's from Andrew. And Andrew, first of all, is very complimentary about how he enjoys this new podcast series on his way from Dublin to Kilkenny, and when he's stuck in traffic jams. So that's always good to hear. He has a question now. He has dealt in the past with institutional investors, currently more on the advisor side, and he wanted to ask us, or he says it would be interesting to hear our views on how to get the message across to advisors regarding systematic and the expectations. For example, let's say the trend has a tendency to underperform in very strong bull markets, for example. A lot of the podcasts I hear, he says, clearly identify this potential underperformance, but tend to keep it in the language of the quant. Not entirely sure what you mean, Andrew, by the quant, but I'm just going to throw it out to Moritz and you, Jerry, and see whether you have some feedback as to, in particular, when dealing with advisors, what are the best ways to sort of highlight the pros and, of course, the cons for with regards to the systematic trading space or trend following space.
So regarding the underperformance in a bull market, never forget that a diversified trend following system doesn't just trade the equities. It trades FX, bonds, commodities in addition to the equities, maybe even other markets. So the comparison to just the S&P 500 or whatever equity index you're looking at just doesn't really cut it. So that's the first thing I'd say, right? And then secondly, it just depends on trends. If you have a more volatile, choppy market environment, you're not going to perform that well. So you always have to regard it and look through that lens and ask yourself the question, is the trend following system doing what it's supposed to do given the market environment? And as long as you can answer that question with yes, it is exactly what it's supposed to do, then you're fine.
Yeah, and maybe I'll just add to that, because maybe that's where also, Andrew, you were going in terms of your question. And that is, I think with advisors and of course, maybe there's less so today in terms of interaction between clients and advisors than there used to be in the old days, where every single trade almost had to be a discussion between the client and the advisor. Maybe that's one thing we're missing out today. But of course, it's really down to the explanation of, you need to have a strategic asset allocation across your portfolio. And there's nothing that, at any time, doesn't really matter when, but at any time, there's always going to be one asset class that's going to do better than the others. And there's nothing wrong with that. So the fact that, equities will do better in a raging bull market, that's just natural and it's perfectly fine. As long as you experience the overall benefit of the other asset classes in the portfolio from time to time, and therefore you can achieve your sort of improved risk-adjusted return for the overall portfolio. So again, like Moritz said, I wouldn't focus too much about one specific scenario, but of course the explanation is that, well, that's perfectly natural and it's meant to be like that, I would say, but you probably have to visualize it in some ways. I remember back in the day, Jerry, when I worked with you, there was a lot more sort of wirehouse money in our industry. So there were a lot more advisors involved, and maybe today. How did we go about back then describing sort of or getting the message across to these advisors vis-a-vis trend following and their clients? Do you have any historical wisdom that you can share?
I don't really remember, but probably, like we said last week, more of not crisis alpha, but the efficiency of the portfolio. If you add CTAs, diversified CTAs and trend following, it's a good portfolio diversifier, the efficient frontier. I would say that I thought he was talking about stock trading, trend following stocks. And so if that's the case, I think that at the end of 2008, trend following equities, let's say, was doing really well. Fast forward 10 years later, it's doing really poorly. One of the things that one would have to do, I think, in general, to compete with the S&P or compete with the stock market, if you're trend following stocks, would be to use a little bit of leverage to make up for the shortfall that you're probably going to get. It's going to be a better Sharpe ratio or whatever, and a smaller drawdown trend following, but to make the same return, you may have to leverage up a tad. So I think, but we'd like for these people and to adopt the ideas that we do, which it's non-negotiable. We're not going to not use trend following. We're just going to always use it. It's part of our lifestyle. We're going to diversify. We're going to take small losses. We're going to pay attention to price only. We're going to do short trades. We're going to not try to buy the lows and sell the highs. And so that's what we would like everyone to believe and have that philosophy, that in no way would we enter these treacherous markets with anything less than that philosophy. So until we get there, we have to deal with these questions of why is it doing what it's doing? But in essence, in our heart, we don't care. I'm never going to take large losses and small profits, and I'm never going to not diversify and be counter trend or pay attention to other things other than price.
Absolutely. Now, one other thing you mentioned, Andrew, in your question, that you also try and visualize things. One thing to think about, and I did this, or I shared this analysis with my clients this morning, actually. And that is, if you look at drawdowns, and of course this is top of mind right now, and you look at drawdowns of, say, the CTA index, Barclays CTA index, for example, and you look at drawdowns of the S&P, what you find is that, first of all, if you take like a 5-year period for calculating your volatility, so trailing 5-year annualized volatility, and you look at the drawdown of the S&P, then the maximum drawdown we've seen in the last, since year 2000, it's something like 3.6 times the 5-year annualized volatility. But for the CTA index, it's only about 1.9 times, and I'm sure you'll find individual managers that might even have, lower, say, vol-adjusted drawdowns. And the other thing I noticed was that 36% of the time over this 18-year period, the S&P had been in a drawdown of more than 1 times its annualized volatility, while the CTA index, it was only 22%. So again, I think putting a historic perspective, looking at drawdowns in a slightly different way than just, absolute numbers, but actually looking at the fact that, when you use a certain amount of leverage, you also have, bigger drawdowns. But when you adjust for that, equities are not, is not the holy grail by any means of the imagination. It's just that it's been a while since we've seen this, and therefore people tend to think of this as being very risk-free. And I was also listening to a very interesting interview with someone, and I forget his name, but someone who's been in the business for, 40 year plus. And he was explaining how people back in this was someone who started in the 70s. And he said, back in the 70s, you couldn't get anyone to buy stocks. Why was that? Because basically stock markets had done nothing for, a 16-year period from 1966 to 1982. There was just very, very few returns and certainly drawdowns along the way in the equities. So you couldn't get people to buy any stocks. And of course, we now see the complete reverse, that everybody wants to have stocks because that's what's been performing well for the past 10 years. And that's just something you can only, I think, be reminded by studying history, and certainly in my belief is that markets do go in cycles, and we are most likely to see a reverse of that at some point. So, anyways, Andrew, thank you for your question. I'm going to jump to the next one, which is from George, and although you mentioned, George, you have 4 questions. I read the first part and I felt it was maybe more of a statement than a question as far as I understood it. But it was this discussion between systematic and discretionary. And I think you make a point, or maybe a question, whether, in the future, if some kind of hybrid of the two, a baseline trend following system complemented with fundamental macro, might be better. And we can certainly hear what Jerry and Moritz think about that. You do have some specific questions really with regards to position sizing is the first one. So George says, first, can you discuss position sizing? I've heard some use a percentage of AUM divided by contract value. So $100 million AUM with a 5% position means $5 million per contract value equals contracts to buy. Alternatively, some define a stop in market price terms, then translate that to dollars per contract, then determine how much they want to risk of the total AUM and find the number of contracts, and so on and so forth. And other people do use volatility. So maybe we can start there and just discuss maybe the point that George makes about, should you actually use a combination of fundamental and systematic, and then also maybe a little bit about how you look at position sizing and so on and so forth. And maybe I'll pass it on to you, Jerry, first, since it was a question that was sent to you.
I think the turtle money management that uses volatility, I think it's in the public domain. I think it's out there. I haven't been able to improve upon it, but using the ATR and losing the same amount of money on every trade and giving each trade the same room in ATR terms, I think that's really good information, and you should check it out and use it. I haven't been able to improve very much on that basic idea. It's really, really great.
Sure. And just before we jump to you, Moritz, in terms of the other point that George raises about, should you combine systematic with fundamental? I know, of course, which camp you're in a sense, but is there anything you want to comment as to why you think, systematic only is going to win in the long run, or is the one you prefer in the long run?
Yeah, this one sentence caught my eye. I think the future is 100% machines, it feels like. So we won't be making any decisions. But yeah, I think that this is another way we want life to be, which is it's trend following. Using trend as one thing in my toolbox. And I think that's not the way to approach it. It is the entire toolbox. Keep everything else out. And that's the way to be consistent. And that's the way CTAs approach it. We're not using trend following. We are using systems, and our goal is for them to not change very much, not have to make them change, follow those rules all the time in every single market. We have everything planned out, massive diversification. We don't even want to beat the S&P. My goal for my stocks are to have some longs and shorts in the midst of a huge uptrend. It's all about risk and diversifying that risk, whether it's stocks, longs and shorts, vastly diversified, a portfolio that's not dominated by 5 stocks, not even in that game. So this is our life, our business, our job, and we're not using elements or concepts of trend. We are using systems that, due to our research, we have determined that that's the dominant force in the markets, getting in gear with the major trends. So I think that the goal here is to not do anything other than follow those systems and improve them.
Before we come to you, Moritz, I just want to add to George's question here. And I think to some extent, if we just take the last week as an example, and you see that oil hits 28% drop from its recent high. We see nat gas, it's up, I think, about 50-something% since its low. I mean, these are big moves, and I really wonder what investors would do without rules when you have market conditions like this that are pretty volatile and flying in all sorts of directions. If you want to be diversified, of course, if you're just specializing in one stock or one market, okay, maybe you can have, enough of knowledge and time to digest everything that comes in. But if you want, like us, to be fully diversified, there's just no way, I think, that a human being can computate and take in all of that information and put it into some perspective. And I think the true value of systematic was clearly seen, during the latest financial crisis, where I think a lot of the fundamental guys were finding it incredibly difficult to stay on top of things, and where, trend followers and other rule-based strategies, we come into the office every day and we know exactly what we need to do. And I think that's an underappreciated, part of what we do, because very often, markets are not in an extreme, but when they are, it's certainly useful. Any thoughts, Moritz, on these questions? And maybe I should add that George also asked a little bit about, even though I think you answered it perfectly, Jerry, rule of thumb for how far a stop should be. If it's too tight, you get stopped out. If it's, et cetera, 1% away, 5% away, and so on and so forth. So maybe just, take that into consideration when you make your comments.
So your answers were all perfect. I agree with all of them. It's just rules only with regard to his statement. And I say that because I've got my finger burned far too many times. I kind of like have that money graveyard here in my office because of all those decisions that I've made when I try to override the rules and be smarter than those. So I don't do that. And like you said, Niels, if you have a large portfolio, there are CTAs out there trading 200 markets, but even if it's just 50, overlooking all of those markets and having a clear opinion on what's driving their prices and their returns, for a human being, I mean, I'm not smart enough. I can't do that. It's just impossible for me to overlook all that and come to any meaningful, substantial conclusions as to where price is going to go next. So rules only.
Yeah. Go ahead.
Yeah. And then with regard to the position sizing, I do what Jerry outlined. It's an ATR based position sizing. It does have an initial stop, and that gives you, that gives you some risk. And as a function of that, you determine your position size. Now, if you don't have, think about a strategy that would say we use the moving average. So you don't necessarily have an initial stop there. You say if it crosses the moving average, you go long, and then you're long for as long as the spot is higher than the moving average, and you would exit that position and go short if spot crosses the moving average from top. In that way, what he's saying with his first part of the question is that you risk 5% of your portfolio. I wouldn't do it that way. I would still take volatility into account and say I'm going to have a greater position in less volatile markets and vice versa. So whatever is done, in kind of like every time I take on a position, the volatility of that market plays a role. That is extremely important. I don't see it working any other way.
Good. Perfect.
Another fun thing. Another fun thing he wrote in his question. I really like this one sentence. Human insight can help assess a situation where data is clueless. Coffee is in an obvious downtrend long term, and then the recent upside quote unquote breakout, which it's not, I guess, a real breakout because it's. And so I've heard people tell me this over the years. Experienced traders, it's the obvious trades. And I'm thinking to myself, I don't have a category called obvious trades. They're not obvious. Price is not clueless. It may be clueless, but it's the smartest thing out there. Everything else is more clueless. So I think that submit yourself to the price. It's safe. You may not get this trade right, but are you willing to say when you do the back test or you have experience, making money is enough. That's enough. I'm going to make a fair return with a reasonable drawdown and risk. That is enough. It's not going to handle some of these trades the way you want them to. The recent trades, I don't like them. But are you willing to say, submit to the system and say, just making the money for me will be enough. I'll be happy over the long term, and I'm not going to complain or get too upset about these recent trades. And that's what we're all kind of uptight about, is the recent ones. But it's
this is so important what you say. I'm sorry, but exactly. I mean, this is not an opinion contest. This is about making money, right? I mean, the opinion to say coffee is an obvious downtrend. Well, I don't know that. It may be in a downtrend, but is it really obvious? That's an opinion. But in those markets, I don't see the opinion contests making you money. The rules make you money.
Which is, of course, why there are so few trend followers on CNBC and Bloomberg to come and discuss their
That's right.
Because they can't say anything.
Exactly. And then the successful people who called it correctly and used their judgment, they frequently have one good trade in them or two, and then it stops working. And so we're just talking about safety here. Navigating treacherous situations and not getting yourself in a bad situation. I'm sure some people had a lot of analysis that we were buying the natural gas from somebody at that breakout, probably some smart people who had made a lot of money selling that upside breakout. It's the first meaningful breakout in a long, long time in that market.
Mm-hmm. Yeah, absolutely. Okay, great stuff. Thanks, George, ever so much for your question. And by the way, do let them keep them coming. We love to hear from you, and we love your questions. I would like more questions, actually. If I was to be frank, I would love to have more questions from investors. I think a lot of our questions comes from people who are on our side of the table in this industry. So keep those coming. But if you are investing in funds out there, I would love to get some of your questions as well. Here is the last question for today from Francois. Francois has previously submitted questions, so we are grateful for these additional ones, Francois. So this goes a little bit about asset allocation or portfolio construction. And the question goes like this. Let's say I want to construct a simple portfolio using 4 asset classes: equities, bonds, REITs, and commodities. From there, I can either deploy my cash by using a naive 1/n allocation, 25% on each, or by using a risk parity approach by sizing based on volatility. In other words, allocating more to low vol assets, less to high vol assets, maybe rebalancing at some point in time so that in the end I keep about the same unit of risk per position. Classic stuff here. The next level would be to introduce correlation matrix between the 4 asset classes. If, for example, equities and REITs are highly correlated, then maybe I should allocate less on both. So I always wonder if CTAs use these correlation matrices, and if yes, how? Your opinions, please.
Yes, definitely use that. Looking at correlation, and that plays an important role in portfolio construction. I think the question is, do you have a, is that changing all the time? So what I mean with that is, do you continue to calculate correlations over different time periods every day? And as a result of that, change your next position size, because, maybe correlations have gone up in the past, say 20 days or 100 days. And that causes you to take a smaller position the next time you get a signal? Or do you have a more static approach, like a static correlation matrix, where you say, okay, I think long-term correlations between equity 1 and equity 2 is 0.8, and between equity 1 and REITs is 0.6. I don't know, I'm just making up those numbers. And we'll just keep it at that level because this is based on a very long-term historical observation, and you make a correlation estimate conservative enough so that you don't take on too much risk in the portfolio, but keep that number static until you have a very meaningful reason to make a change and update to that number. The latter approach is what I'm doing. I'm not letting the system get influenced too much by a change in short-term correlations. I'm looking more at the very long-term behavior of asset classes and markets, and that then drives position sizing.
Great, appreciate that. Jerry, any thoughts on this topic?
I would just try not to get too carried away with the correlations and the changes, like Moritz said. I think there's some crude and heating oil are correlated. Take that into consideration, silver and gold, the obvious ones. And then the obvious ones can not be correlated. I've mentioned before a few times heating oil has had really huge moves and crude didn't move. Silver, 1987, went up a lot. Gold kind of sat there. So, and then they go right back to being 90% correlated. So I don't know, you got to figure out how you want to deal with that. And one of the benefits of trend following is when things happen that have never happened before and can't really be predicted, we're following prices. We're going to be right there doing the right thing. So you don't want to get in the way of that too much, but then it doesn't make a lot of sense to not take into consideration silver, gold, platinum. They're pretty much moving together most of the time. So make a conservative, moderate adjustment infrequently.
Yeah, and I would say, Francois, from our side, I would say that we probably use correlations perhaps more than Jerry and Moritz do, because we don't necessarily just wait for new signals to adjust things. We look at the portfolio, on a daily basis from a more statistical point of view. So we do take correlations into account, but I completely agree with Jerry and Moritz. It should not be the overriding driver of your allocations within your portfolio. That should be done by signal strength, in my opinion. But it's silly not to take correlations into account, because they do matter, of course. Great, appreciate that. That was really the questions for today. Let me just, before we start wrapping up, let me just mention a little bit of performance numbers. These are as of Thursday evening, so the 15th of November. We have the B-Top 50 index down 0.71 for the month, down 5.58 for the year. SocGen CTA down 1.23 for the month and down 7.31 for the year. SocGen Trend Index down 2.07 for the month and down 9.26 for the year. And Short-Term Traders Index down 1.22 for the month, down 1.19 for the year. And the Flat Fee Bridge Alternatives Index down 1.48 for the month, down 8.34. As I said, these are from Thursday. I have a feeling that Friday did move the needle a little bit. So just take that with a grain of salt if you see numbers at the end of the week that looks different. Anything else you want to bring up as we start to close down for this week?
You've just mentioned 10 numbers, every single one of them negative.
Yes.
Sad.
Well, it's been one of those years, right, where
yes,
so many things has not worked. Very little benefit of diversification, even sometimes down to the day, as we spoke about when we looked at what happened on November 1. I mean, it's just been a horrifically difficult period for many strategies. That's no other way of putting it.
Seems that way.
Yeah.
I think the most important thing I've learned over the years is that some people just have the ability to withstand and continue to withstand the bad performance and the disappointments. And then when the trends come and opportunities come, they nail it as if they have perfect confidence. And so let's get ready to do that and follow those systems and trade a little bit smaller maybe, but don't let anything get in the way. Don't concern yourself with your own confidence. Put one foot in front of the other, do those trades like you're supposed to, and it'll be better. It may not be wonderful, but it'll be better than the alternative.
Yeah, I completely agree with it, Jerry. And I can't help thinking, and it's certainly not a prediction, but I can't help thinking that what we've experienced this year really reminds me about what I saw in 2007 and 2013, prior to some of the strongest periods in this industry. We had some of the worst, back-to-back months certainly in 2013 and certainly in the summer of 2007. Really tough market conditions for trend followers, followed by some really strong opportunities. So I completely concur with what you said, Jerry. It's just about one day at a time, and the markets will give us the opportunities, and we'll be ready for, to capture those. Anything else you want to share today, or should we wrap it up?
Happy trading.
I saw the hashtag.
Yeah, there was one person saying.
There was one guy who started hashtag happy trading. I think that's great.
Exactly.
Yeah, absolutely. Okay, very well, good. On that note, let's wrap up this week's conversation. We hope you enjoyed just as much as we love discussing these topics every week with you. And if you do, please, please share these conversations with your network, your tribe, and of course we always love to receive a rating and review on iTunes, because it really does help us broaden the message. So from Jerry, Moritz, and me, thanks so much for listening, and we look forward to being back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.